Credit scores will never be the same after 2025. I'm here with Matt Komos from OGMA Risk and Analytics. Matt, you've been in the credit scoring, the lending world for 25 years. You founded this company, and I wanted someone like you on because you just have a breadth of knowledge that's a lot different than someone who works to improve a credit score or understands debt. And that's so thanks for being on.
Oh, it's my pleasure, and I really appreciate you having me. Yeah, I've worked in and outside institutions. I've worked cumulatively at TransUnion for almost 12 years, so worked directly with credit data, understanding how it's incorporated to credit scores, things that consumers can do to improve their credit or things to watch out for. So it's an exciting times in this, in this world. So I'm looking forward to our discussion.
Well, great. Well, thank you, Matt. And let's just so we're talking to people, as I mentioned, who are just in the trenches trying to improve their credit score, don't understand their credit. Everyone, this is so confusing. It's like a black hole, right? And then there's all these changes, right, of what happened. So first of all, let's talk about where credit's going in the short term, in the next year, 3 years, 5 years. What do you see changing on the horizon?
Yeah, so I think this evolution has been in motion for some time. What's really interesting is many of the prime credit scoring companies, as well as the credit bureaus and lenders, are more and more trying to understand how to incorporate alternative data,
Mhm.
things that might not be on the traditional credit file.
Right,
And of course, they have to be FCRA compliant, but how can they incorporate these things like rent reporting, utility reporting,
right,
just to give that holistic view of the consumer. And
right.
so I see that those components are going to become more and more valuable
Hmm.
over the next probably 3 to 5 years.
Hmm.
One piece is those credit bureaus need to collect that information from the providers
Right,
and then start incorporate them, buy now, pay later, right? That's a hot
right.
topic.
Hot
Um,
topic, hot,
hot
hot topic.
topic, right? And up until now, it's been a question of like, how do we contemplate these debts? Because they don't follow a traditional model. I'm paying it
Right.
in 4 weeks, 2 weeks, whatever,
Yeah,
and they're
yeah.
these small dollar amounts, right? So I think a lot more rigor around incorporating these types of data sources. And the ultimate goal really is to give the consumer the best shot at getting the access to credit they deserve. The credit bureaus become kind of that linchpin with regards to getting data
Right,
for a lender.
right,
It helps the lender get as holistic a view of the consumer as
right.
possible.
For guys like us and people in the trenches, we have to play the game because it's frankly really unfair, right?
Yeah,
Like in my opinion. And like so let's unpack that for a second. Yes, they have to get a holistic view, but what the bureaus are really doing get the holistic view because they want they get paid by the banks. I mean, or the lenders. And it's really weird if you think about it, right?
yeah,
Like like I've always like been frustrated with this. Um,
yeah,
so the person that pays the bureaus, right? They make it hard to fix the credit report. I mean, you saw that 60 Minutes episode. They got people reviewing credit reports in South America without a phone for
right.
errors. I mean, it's like, I mean, I don't know if that's the case now. That's what it was when it was on 60 Minutes. It's like, how does that work? And the bureaus don't, it never feels like they're on our side because why would they be on our side? We're not paying their bills.
Right.
Like, what are your thoughts on that? Like, push back, feel free to push
Yeah.
back. Like, but do you see, it's like fundamentally, they don't care about the client. Do you
Well, I
agree with
would
that?
no. So having worked at TransUnion for a long time, I can
Uh-huh.
tell you the bureaus are trying to play a neutral party in enabling an ecosystem
Hmm.
where these transactions can occur.
Right.
Now, I will say many institutions that might be hesitant or not really doing a good job of fixing reporting errors, for
Right.
example,
Right.
that's on the institution, right? Because the
Right.
credit bureau can't, they don't have the data of record to go in and make those corrections, right?
Right.
You
Right. Right.
file your complaint with the bureau,
Hmm.
they reach out to the creditor and say, hey, this person said this is
Right.
inaccurate.
Right.
It's a challenging process
Well,
for
and
sure.
that's why we have the Fair Credit Reporting Act. You mentioned FICRA,
Yeah,
so that like in the event there's an error, it's, attorney fees are included if they don't fix it. So there's that
yeah.
T, right?
Right, right.
Okay.
But at the end of the day, right, short of having something like a national credit bureau, which
Mhm.
that might be beneficial, right, where you're required, and many countries do this, all the institutions they're required from a regulatory standpoint
Mhm.
to report into a centralized repository.
Right.
That kills competition though, right? And the bureaus are trying to, they're bringing benefit to consumers in a multitude of ways. They all have consumer direct businesses that help consumers, they coach consumers, they try to help them, educate on what
Right.
credit scores are, right? And how to improve your
Right.
credit. Going back to your point though, I think I mean the thing is it's a give to get model, right? So if I'm a lending institution that, yes, I'm paying the bureaus for that access to that data,
Mhm.
right? But I also have to report my data in so that the whole ecosystem is complete, right? So
Right.
the thing you don't want for a consumer, like the consumer gets hurt if their credit file is incomplete because it's not showing all of the positive action they're taking, or maybe, where consumers are struggling. And frankly, putting them into a new loan is not a good idea, even though the
Right.
consumer kind of feels like they should.
Right.
So that in my view, there are some guardrails that kind of help the consumer, on that credit journey.
Right.
But it can be complicated for the consumer, right? It can be confusing, right? And that's
So
where education tools have been helpful. Yeah.
yeah, I mean, but the thing is like TransUnion, Equifax, Experian, the big five thing on how to improve a credit score. Utilization rate, 35%, 10% inquiry rates, 35%
Yeah.
payment history. It's a bit of a racket. Like, as someone who's looked at hundreds of thousands of credit reports, right? You've looked
Yeah.
at a lot. The inquiry thing isn't, let me give as an example. Like, come on. Like, I think that's like, okay, does it impact credit? Yeah, but like on the margin, like so small. It just seems disingenuous. But let's just move on for a second. So you mentioned the give and take, like you have to, in order to receive the information, you have to report the information, right?
Yeah.
Is that actually the case? I didn't realize that anyone who buys information from TransUnion or Experian TransUnion, they have to provide all the information.
Yeah. It's
Oh,
give to get. It's give to
well,
get. Yeah.
wow, I didn't know that
Yeah.
because I mean, I've had full-on conversations. Like, what about the people that don't report to one of the bureaus, for example? Does that mean they're not getting that data from the bureaus?
Yeah, likely. So yeah, many
Oh,
lenders use only one bureau.
yeah,
Some
right, right,
use
right.
some
See,
use
this,
all three.
and
Yeah.
this is the complication of the racket, right? It's like you have lenders that use one data source and it skews all the files. But I guess from a lending perspective, you're looking at the law of averages. It's like, hey, here's the deal. Some are going to report here, some are going to report here. Is that the
Well,
way
yeah, and
lender?
many so years ago it was much more common where you'd have like regional differences. So
Mhm.
if a lender was heavily concentrated in the Southeast, they would go to Equifax,
Right.
for example. If somebody in the Midwest would go to TransUnion. That is much less, and frankly, a lot of lenders report to all three because it's an
Mhm.
easy process. Everything's
Right.
automated. It's pretty simple.
Uh-huh.
But yeah, as a lender, you're trying to evaluate, right? Ultimately, you're trying to ascertain like the risk on a given consumer. So I want as much
You
information
want
as
as
I can.
much data as possible. Absolutely.
Yeah, right. Just to be able to make that assessment. So even if there are some gaps at a given credit bureau,
Mhm.
I'm trying to fill those gaps in with, and now there's like bank transaction data, right? That gives you a very good view into consumer behavior and their patterns of where they're spending money. And,
Right. Very, probably the
very,
best, right?
yeah, it's much more accurate than
Yeah.
credit data, actually.
So,
um,
yeah,
yeah.
most people are using all three bureaus now. If that's the case, does the scoring differences between Experian, TransUnion, and Equifax simply because of their scoring model, the way their scoring models work?
Yeah, so it really depends which score you're talking about because, for example, you've got FICO score, and
Right.
those are built on each bureau's data. So if there are discrepancies or differences in the
You're
files
going
in
to
the
see
credit
that.
data, underlying credit data itself, you're going to get different scores because that, you can only build on and score what data you have.
Hmm.
What the whole point of VantageScore was to kind of alleviate that issue
Hmm.
because, all three bureaus participated in that development, and
Hmm.
they basically leveled the credit data across every consumer in that
Right.
sample. So in theory, like using a VantageScore and the attributes that they create, you look the same, assuming there's a difference in, okay, you have a trade reported at Equifax but not at TransUnion. Those are different.
Hmm.
That creates a discrepancy in score because
Right.
it's asymmetrical information. However, assuming all your trades are reported at all three bureaus,
Right.
then in theory you should have the same Vantage score across all three
Right.
bureaus.
So
You
why
know,
hasn't, let's talk about Vantage for example. When
yeah,
that came out, it was like, this is it.
yeah.
This is it. But it hasn't really taken on, like it didn't like dominate the market, right? It
It
still
hasn't.
hasn't. Like,
No, it's
why?
still. Although I will say it has taken over a much higher proportion. Like there are a lot of people moving toward it.
Oh, they are. Do
Yeah.
you see that in the future? Like, do you see where VantageScore will be the place in X, fill in the blank. In X number of years, VantageScore will be the score. Is that fair to say?
I think that there are dynamics at play that won't necessarily allow that.
Okay.
Where for many lenders, FICO will always be the gold standard because they've got a lot of tied up, a lot of their systems are tied into it.
So tied in,
They're
yeah.
doing their securitizations, like what,
Yeah.
there's like a whole ecosystem they've built around it.
Yeah.
However, I think that within the next 5 to 10 years, we will see like the market share shift to almost being equal.
Oh, really?
That's my
Good to know. Good. Hey,
knowing, just knowing the
yeah.
performance of and seeing
And it's
how
work because it's
VantageScore
more effective,
performs
basically what you're saying.
in
It's,
some cases, right?
yeah.
In certain portfolios, right? Not necessarily across the board. Now, FICO, and we don't have to go into this, but FICO's introduced a whole new model that disintermediates the bureaus.
Hmm.
It's that direct licensing model. So
Hmm.
what will be interesting to see is if they try to do that to every industry. It's
Huh.
right now it's just focused in mortgage,
Yeah.
right? So they
Boy,
basically are
they,
saying you don't have to go to the bureaus to get our FICO score anymore.
wow.
Will be interesting to how that plays out, but we could have a whole discussion.
That's a whole nother video.
Yeah,
Matt,
exactly.
Matt, let me ask you, like rent reporting and all this stuff. See, the problem with this whole concept is it's like a pay to play, right? It's like, oh, you want to pay me $30 a month or whatever the number is. You are going to get you're going to get this on the count. You're going to get this reporting. I mean, the problem is you got a small segment of the society doing that. How does
Yeah.
that make it fair from a view, from a perspective of credit scoring? Do you see what I'm
Yeah.
saying? Like if a,
Oh
if you get
no.
the people who are paying for it, it's got to be an all or nothing. It's like all credit cards got it.
Yeah. So I think there's a couple of paths that could make that happen. Either it's going to be forced by law. So
Okay.
at some point, right, if legislators say there's enough value in this data that it should be included regardless, and they
Uh-huh.
force the issue through a law,
Right.
that would be one way. Another would be that landlords and the rental companies see the value and VantageScore, FICO, the bureaus, they've all put out plenty of studies to show the benefit of rent reporting
Hmm.
and how much it actually can improve consumers' credit,
Hmm.
their scores.
But
So,
it improves the score on their model. Like that's the problem,
well,
right?
no,
Like,
no, they did these studies where, they've gotten independent, sources of rental data, and they
mhm.
simulate, okay, if this had been included as a trade in the consumer's file,
Okay.
and yes, it's going to be specific to each of their scores, but
And
these are
and and
all the,
and and what type of line item would this be?
well, it'd be like a new trade, right?
But
So
like would it be? I mean, it's not revolving. Would it be an installment? Like what does that look like?
I believe they would treat it as like an installment
Okay.
product. Um, And in some regards, I think over time, as new reporting comes in, you could create it as a new trade type
Yeah.
potentially, right?
Well, I
Just
mean,
rent. Yeah.
that would be a huge win because
Yeah.
like
Yeah.
more like this is rentals are a big thing.
Huge.
I mean, and like, as a landlord, that I mean, I don't even, frankly, like credit scoring's one thing, but I have some of my best tenants
Yeah.
that had horrible credit scores because I know enough about credit that I can be like, okay, tell me the story, right?
Yeah, because oftentimes there's a story behind a
There's a
bad credit
story
score.
behind bad credit. And most of the
Yeah.
time, they don't know. This is what drives me crazy because
Yeah.
even the education that's put out by the bureaus, I think it's intellectually dishonest. Like, and
From what regard? From what
well,
regard?
just like how to do it. Oh, pay your bill on time. Huh? No
Uh,
kidding,
yeah.
right? I mean,
Well,
like to even have to say that you have to pay your bills on time
yeah.
is like okay. So
Yeah.
like, let me give you
No
my
brainer. No brainer,
well,
right?
yeah, I mean, it's just so unfair to say it. It's a wasted breath. So like my thesis at the highest level, right? At 720 credit score. It's basically you got to get the errors off the credit report, and errors are errors, like not late payments, not like, oh, I forgot to make this payment.
No,
Like,
but
I mean,
mistakes,
like
like
these are
genuine mistakes.
errors, right? Yeah,
Yeah.
it's like it's a mistake from the bureau. You got to make it happen, and we have FICRA, Fair Credit Reporting consumer attorneys who will review your credit report and like make sure
Right.
support you, right? That's the first thing is make sure you have enough three revolving credit cards so you build enough credit roots, right?
Yep.
And then
Yep.
have an installment line, right? One
Yeah.
paid or active.
Yep.
I don't even say you got to pay your bills on time.
No,
Like
that's
if you don't
assumed.
pay your bills on time, like
That should be assumed.
yeah, you cannot win. And I do have people say, "Hey, like, well, I only missed, twice a year." I'm like, "Well, one mistake is we
Well,
start over, right?"
but it does point to, I mean, I do believe, and I've worked across
Hmm.
deep subprime all the way through. I
Yeah.
mean, one of my businesses in the past was targeting consumers that had payday loans to consolidate and extend their term and try to give them a better cash flow
Yeah,
situation.
right. Yeah.
And for many of those consumers, they either don't know the resources that are available,
True.
they've
True.
been, I mean, I agree, like for the average consumer, pay your bills on time makes sense. But for some consumers, their financial wellness,
It's
like what
impossible.
they've
Yeah, right.
learned
Right, right.
is they can miss twice and it's
Yeah.
okay.
Yeah, you're right. Yeah, yeah. Yeah.
You know what I mean? So that there
Sadly,
is
sadly.
unfortunate, right?
Matt, what about debt settlement? Debt validation. I mean, it's a different world than bankruptcy.
Yeah,
Bankruptcy's like we're wipe it off, we're following the bankruptcy code and stuff like that. There's a huge submarket of people that like are buying leads of people who are in debt and really aggressively going after them from a debt settlement. How
huge
does
ramp
that
up.
impact? What
Yeah.
was that?
There's been a huge ramp up in this in
Oh,
the last like
the
5 to 6
number
years.
off the
Yeah.
chart. Well, especially in the last 12 months, these
Oh
numbers
yeah.
are double, triple.
It's like
What
wild.
what do
Yeah.
you see from a credit reporting perspective? Like, is there a difference between that and bankruptcy? And bankruptcy is a one-time hit, it's over. These,
Yeah.
what they do is they just let everything go default
Right.
and
So it's
they're
probably a little bit, I mean, so I think what ends up tending to happen on average, again, this
Mhm.
is on
Yeah, right,
average.
of course.
It's going to be different case by case, but the bankruptcy hit probably drops your score bigger, initially, and then you've got that waiting period until you can even get credit again. So it
Yeah.
takes, it'll take a while to build that credit back up. With debt settlement, first off, I feel like there's a huge difference between the for-profit and nonprofit debt settlement world, right? So that's something for consumers to be aware
Yeah,
of.
yeah, absolutely.
And being cognizant and making sure that it's a legitimate company, that you're not just giving payments over without making sure they're valid, right?
Mhm,
Because
yeah.
I've heard horror stories of consumers paying every month and the company never was paying eventually, they never settled.
It's incorporated in the Bahamas or some weird,
Yeah,
what I mean? It's
yeah.
like, what the heck?
So
Yeah.
exactly, right. But I think again, it will depend on the nature of how much debt the consumer has, right? To your point, you're going to get those delinquency impacts to your score. And you get to a point where like, the score's dropped enough that
Doesn't
a few
matter.
more delinquencies aren't going to matter, right?
Yeah, right,
So,
right.
but you can have, that the challenge becomes like some lenders won't touch you with delinquencies in the last
Yeah.
12 months, right? So
Oh yeah, for sure.
you'll have that road to recovery, but it'll probably be, I would say, shorter than bankruptcy in general. I mean, many lenders have policies, they won't lend to somebody who's had a bankruptcy in the last 4 years, right?
Oh
So,
yeah.
so your access to credit might be more limited.
So just so you know, with we've had hundreds of thousands of people through our program with after bankruptcy.
Yeah,
And yes, you're right. There's certain lenders who would just, hey, this is not our client. But
right.
there's a huge industry of people who will lend to people like right after filing. It's
Oh,
not a credit card you're gonna or a installment line you're gonna want forever.
no,
But it's a builder, right?
it's a
It's like
builder,
you're gonna
gives you
keep it, you're gonna keep it.
liquidity.
We
Yeah.
have clients, we've had one, our fastest was after bankruptcy, this chapter 7, not a 13, 9 months with a to 720 credit score.
Wow.
And
That's great.
but what they did is they got 3 credit cards, they got an installment line just for
They
nine
followed the
months.
program.
And
Yeah.
then what they're going to do in then they're going to get different credit cards, obviously. I mean, you're not going to keep these because you're paying subprime rates and high
Right.
annual fees and stuff like that. But that's interesting. Okay, one last question, Matt. Where do you see credit scoring? We see instant approvals with Klarma, buy now, pay later. And those are starting to report to the bureaus, right?
Yeah. Yeah. It's start. My understanding is that a number of them are going to start reporting.
Okay. And so what does this look like? Like what how does this change the landscaping, the buy now, pay later with what we know about credit scoring in 2, 3, 5 years?
Yeah, so I think it's going to take some time to kind of let this information bake into the system, right?
Mhm.
And then to evaluate what does that type of debt look like relative to all this, this kind of the standard stuff, right?
Yeah.
Because to date, there hasn't been, I mean, I've seen plenty of reports and analysis around, okay, these folks are going delinquent at this rate versus not. There's going to be some portion of the population that is augmenting their income with these types of products because they can't really afford it, but they can, if they stretch it, it helps their cash flow.
Yeah.
There's going to be other consumers that are doing it for convenience, right? So I think it's
Yeah.
going to take some time to understand how these products and other new credit products, credit builder type, products. There's plenty of players out there. Some of them are actually valid credit building products. Others
Mhm.
are not. Others are basically tracking your debit behavior and
Yeah.
then they're trying to report it as credit.
Yeah.
Those are not good products because they are harmful to the consumer. That might put a consumer in a product they shouldn't have, because they get this credit score that jumps up, and the reality is they haven't figured out how to properly manage debt at this point,
You
right?
have
So
to understand the system.
you have to
Absolutely.
understand it. Yeah.
Absolutely.
And so yeah, I think like there's going to be kind of these incremental ads in terms of alternative data, stuff like rent reporting. Again, I'm hopeful that it becomes a law that these folks have to report rent because these consumers should be getting credit for this, you know, housing payment, whether it's a mortgage or rent, is one of the largest, if not the largest
It's a
payment in your
very
wallet.
important thing. Very important.
Yeah, yeah. And so, my hope is that these types of things start getting included and that, consumers' access to credit continues to grow. They have the ability to utilize things like, again, subscription accounts, right? I'm paying my insurance premiums, right? None of this stuff is really factored in,
Yeah.
but it all affects your cash flow and your ability to repay.
Yeah.
And so the more information we can kind of bring to the table, I think the better.
That's a really interesting point. I mean, you're supposed to have insurance. Everyone's supposed to have basic car insurance. And the
Right.
people that don't carry it are inherently,
Riskier. Yeah.
riskier
Yeah.
than people not. Like, that's a really good point. Matt, I appreciate you having you on, and we're going to have you back.
All right. Thanks, Phil. So much appreciate it and take care.
We'll see you soon.